us for today's virtual bootcamp, Mastering Bootstrapping and Financing Strategies for Entrepreneurs. We're all really excited to dive into an intensive hands-on session, which is designed to help you take control of your financial strategy and scale your business on your own terms. Leading today's session is Wayne, a deep tech investor and principal at Green Sky Ventures, managing over $70 million in assets with a background in biomedical sciences and materials engineering. Wayne brings a wealth of expertise in fundraising, startup operations, and more. So get ready for some real world insights, practical exercises, and live discussions. We're all really, really thrilled to have you. I would encourage, if you're comfortable, turn on your camera so that it's a more interactive experience. And I'll hand over the stage to Wayne now.
Cool, awesome. So you're ready to kick off? We have everybody on? Yeah, okay. Okay, awesome. Hello, everyone. I want to talk today a bit about bootstrapping, financing strategies. As we go through, I guess, the presentation, the workshop, I would love for you to share your story as well, so that we can talk a bit about your situation, and specifically the business that you're building. This is not necessarily for startups that are looking for venture capital money. It could be for small businesses. It could be for anyone looking to build a business. So I appreciate it if it's interactive, and we can go through exercises together, and we can hear your story as well. I guess, yeah, bit of background myself. I guess Mina introduced me. I'm a materials engineer, now work at Green Sky Ventures. We invest in early stage Canadian startup companies, usually focused on B2B Canadian startups. But I've also worked with a lot of small businesses, consulting services, etc. So I kind of have seen companies that have raised money, as well have worked with companies that have bootstrapped all the way to cash flow positive. What are the, I guess, topics that we want to talk about today? I just want to give you, I guess, a high level intro. I want to make sure that everybody understands the difference between bootstrapping and fundraising. What are some of the things that that you have to consider when you choose either or? You would want to also talk a bit about the freedom and a scale trade-off when it comes to, let's say, bootstrapping and fundraising, and kind of the two sides of the coin. I want to talk about fundraising, but I want to also tell you a bit about the fact that fundraising is not just about getting the check, getting the money from investors. It's definitely way more than just the money. For a company that is looking to bootstrap, obviously one of the things that we want to make sure that is that you prioritize revenue generation from day zero. One of the mistakes that a lot of startups make is that from day zero they go after raising money, and they don't necessarily care about the fact that they have to generate revenue. So they could potentially become very good at raising money, but not really good at generating revenue, or they would become very good at securing grants, what we call grantpreneurs, rather than generating revenue and becoming real entrepreneurs. I want to then talk a bit about capital efficiency and lean operation, and how do you cut fat where you have to, how do you save money where you can. Specifically, one of the main costs of running a business is human resources. So I guess one of the topics should be talking about hiring, outsourcing, and how you manage that. And then talking about exits. So whether you're bootstrapping or raising money, you have to have a plan. You have to have an idea what is really the plan of your business, where you want to go, whether this is a lifestyle or not. There's usually an end game. What is I guess your idea of the end game of the business that you're trying to build? I have a section for Q&A at the end, but what I want to make sure that happens is that we dive into Q&A every step of the way. And so I want to make sure that like the learning objectives are clear. Well, these are the things that I want to make sure that you get out of this workshop. Learn if you're just if you've decided to bootstrap or you've decided to fundraise. I want to make sure that you know why you have that decision. You have made that decision. What are the next steps that you need to do, and you understand the consequences of choosing either route. Um, Understand the smart money and the smart funding and the fact that it's not just a dollar that goes into your bank account, but it's way more than that. Building capital efficient operations. How do you think about not just burning money, but like thinking about um, an operation that is efficient and lean. Prioritizing revenue from day zero is definitely one of the things that I want to make sure that everybody takes home from this workshop. How do you strategically build and scale your team and thinking about that in the context of your business? And then lastly, preparing for if it's funding, if it's exit. But when the time comes, how do you prepare for either of them? So I want to start with really an exercise, and I'm going to have a couple of these exercises throughout the session. But what I want, and I don't know if people are in teams or not, but the first thing that I want to happen is that we take 5 minutes, and hopefully you have pen and paper next to you. But like there are a couple of, I guess, a couple of these kind of exercises that we want to have throughout the workshop. We want to uncover what you're building at and the objective and where you're going with it. And that's why I want to make sure that we spend some time like thinking about what you're doing it, and it's not just lecture and me going through slides, but you really doing a bit of the work and sharing what you're building with everybody else. But maybe we can take 5 minutes. What I want to happen is that think about why you're building the business that you're working on. What are your objectives? Are you thinking about the upside financial? Are you thinking about a specific goal that you have in mind? Is it this a solution that you think the world needs and you want to make sure that the world has? Is it the impact of the work that you're looking into? What is your objective? Why did you decide to build this business? And that is very important because then we can talk about exit better, we can talk about bootstrapping better, we can talk about fundraising better. But I guess think about your business. And maybe after 5 minutes, what we can do is that you tell, maybe a couple of you volunteer to tell us about your business, why you want to build it, what is the objective that you're looking to gain out of becoming an entrepreneur and building this business. And then as we go through exercises, we can think about other parameters and metrics around building the business. I will stay quiet to make sure that you guys have a couple of minutes to think about this. If you have any questions, feel free to unmute and shoot away. But we want to make sure that it's interactive, so you guys talk about your specific problems as well. We don't have to, I guess, wait the whole 5 minutes, but if anybody is volunteered to share with us about their business and their objective, you can unmute. And
Yeah, this is Ekta. Hi, hello. Good
hello,
afternoon
thank
to
you
you.
for volunteering.
Yeah, so this is Ekta Cad from India, and our company is Vivendo. We are into real estate in Canada that we have opted for the businesses. Okay, so we want to really cater the business, the real estate situation in Canada, which is, I think, need to be improvised. So that's why we chose this one. So for that, we are a team of 4 people. So myself handling the marketing thing, and we have one CEO, one person taking care of the sales department, and one she's into the back-end resources. So just to cater the the challenges what the immigrants or the students or anybody, the new people who come into Canada, they're facing for the residential thing or a rental thing. So they should have a proper one place wherein they can get everything. So that's what we have done it on our panel in Vivendo to give them all what they want in one platform.
Got it. And so I guess one of the things that I want to make sure that you understand is that, so one is the mission, which is around helping, let's say, immigrants, newcomers in Canada to be able to manage their I guess real estate situation, whether they want to rent a place or whether they want to buy a place, having a centralized location where they can go and find, let's say, affordable housing, etc. That would be the mission. What are you thinking about the I guess the type of business? Do you think this is going to be a lifestyle business? Do you think this is going to be scalable, venture backable? Do you think there is a heavy technology layer in it? There is intellectual property. What do you think about that part?
Definitely intellectual property that is really required, and kind of AI based AI based structure that we want, and we'll be definitely going to have our technology team behind this so that we can enhance the business project through AI behind that. So that's the main motto, so that more and more people should connect with us, and we can solve ASAP their needs.
And do you think you would need funding, external funding, to be able to build your product, or do you think you have?
As of now, we have, I think, definitely we'll be needing in long go. Maybe we will be doing some more recruitments in our this thing and in our setup. So then they will definitely we will need, requiring more funding for this. Definitely for launching maybe corrections in the website to be more enhanced, more like digital marketing. We have to put in money definitely to market our business. So definitely that is all the time required.
Okay. And I guess what drives you to do this? Are you looking for the monetary upside? Are you looking for the impact? Is it a mix of all of them?
Of course, it's a mix, but money definitely, of course, it is there. Once one does the business to earn, much better than you do for somebody. If you serve somebody, it's better to have your own thing. So obviously, one of the motto is that. So, and obviously to cater this kind of a business, so I have a marketing flair. So I, in India also, I do a lot of marketing in sales, and even to that education sector I've catered to every time. So this is my forte of doing marketing. So we thought that this kind of a business is kind of a smart work that we 4 can be, the best that we can do of our capabilities that we 4 have in this group.
Okay. Thank you, Ekta.
Thank you.
Maybe we can have one more volunteer to share with us a bit about your business, what you're building, what drives you, what is the outcome that you're looking for?
From our group you want, or somebody else to talk?
Somebody else from
a
different group. Yeah.
Thank you.
Hi, how are you?
Hi,
I can
how
tell
are you?
my story. Good, thank you.
Sure.
Actually, it's Incream. Incream, it's a messenger, a private organizational messenger for the companies. And to answer the question that why we build this business, actually, because we have a customer at first that needs this messenger. And after providing this messenger to that customer, we started to explore that we can grow our business, we can like improve it. And now we have the product ready, and we are like analyzing the market and to like scale it up and have some customers and to see that which customers can align well with our product. Yeah.
Okay, great. Thank you for sharing that.
Yeah.
It would be important to think about how you want to run your business, like whether you want to receive funding, whether you don't want to receive funding, whether you want to actually build the product with your own cash, with the revenue that you generate. It's great that you have started a business from the need of a customer. It's definitely a great path to getting to product market fit. So that's amazing. You want to make sure that you kind of decide which path you want to go, whether you position it as a venture backable business or no, this is going to be a lifestyle family business. And then when I keep asking, do you do it for the money? Do you do it for the impact? Why do you do it? What drives you? Is that
actually we are to answer these questions, we are developing another version of our application to like improve the features, but to now we are bootstrapping, but yeah, we are looking for new investors to like going to the market and like having some other big customers, because we focus on the B2B market because our product is B2B, but it is still can be used by end users, by the customers. But yeah, because our first customer was a company, we are still focusing on the B2B market, and maybe like using some customers as like promoting and getting people known about the Cream. But the first focus is on big companies, and we are seeking for like investors.
Okay, awesome, great. And yeah, maybe the last thing that I would add here is that I keep asking, do you do it for money, or do you do it to become rich? Do you do it to generate wealth? And the reason that I ask that question is that there are a lot of different ways to generate wealth. There are a lot of different ways to get rich. Building a startup is probably one of the painful ones. It's not an easy route. Building a company is not easy. Running your own business is not easy. And so what I suggest entrepreneurs think about is that what besides money drives you, just because it can't be just, I want to make sure that I capture the world, the world and become very rich and make it. Just because some days it's very tiring, and you have to essentially be in love with the problem that you're solving to help you move forward. Obviously, the financial upside makes a ton of sense, but just like having that at the back of your head would be great. Feel free, yeah.
Yeah, actually, to be honest, the money is important, but the things that besides the money can like go with this startup, because we are three co-founders that we all expertise in the ITs and the network, like and especially in these kind of like applications like messenger and telecommunication products. And because of that, it really aligns with our expertise and our experiences. And because of that, we just like doing something that is relevant to our past information and our like now expertise. And because of that, we can get money from this product. Yeah.
Okay, great. I can move forward, but then
sorry, Ryan. There's another message from Deepak. He sent me a message about this company. I'm just going to read it out to you. It is Deepak from Settlebay Incorporation. We're building Settlebay to address a critical gap. Canada welcomes 500K immigrants annually, but 60% face underemployment and isolation. As newcomers ourselves, we've scaled our own struggles into a tech-enabled platform that combines mentorship, AI-driven career tools, and community hubs. Our goal is to unlock $10 billion in untapped immigrant earnings by 2030 while fostering inclusive growth. And that is Deepak. Feel free to, Deepak, unmute yourself and engage with Moin about this.
Great, I guess great pitch. I just wanted to make sure that the exercise is very, very honest to yourself. Think about what you want to achieve. What is the end game that you are thinking about? I know some of you are like overseas. Obviously, one driver would be immigration. One driver would be building a business that generates revenue. One driver would be the impact of the work that you're doing globally. But just think about those, because as you're building the business, as you go through the process, and as I will flip through these slides, we would get to points that I will get back here and ask you, okay, you decided that you want fundraising. Is this actually the right decision for you? Let's revisit that. And yeah, thank you for volunteering and sharing your stories. I would make sure that that we have the floor for other participants as well moving forward. But let's dive a bit deeper into this topic. I mentioned bootstrapping maybe a couple of times now. The topic talks about bootstrapping versus fundraising. So I want to make sure that we obviously spend some time here. So one question that people ask me is that which one is better? Is it better to bootstrap, or is it better to raise money? And I wanted to lay out what are the challenges, what are the upsides of each of these decisions. So obviously, if you bootstrapped, this is your business. You wake up 7 a.m. and work on your business. Nobody says thank you. It's your business. You're building it. You close shop early and go on vacation for 3 weeks. Nobody tells you, why did you close down and went on vacation? It's your business. So if it grows, it's yours. If it fails, it's yours. You don't have anybody to respond to. Usually the bootstrapping process is associated with slower growth. Obviously, you don't have money to burn, so you have to be very cautious on where you spend money. Let's say you want to develop a product, you can't just spend money on buying on hiring 10 developers and build a product very quickly. It might take you some time to build your product. You might be even building it in various steps over a couple of years. So you have a slower growth when you decide to bootstrap. There's nothing wrong with that. Not a lot of businesses would require fast pace to be successful. So you don't necessarily need to be thinking about, am I developing this or building this product or building this business quick enough or not. It really depends on the type of business that you're dealing with. When you're bootstrapping, I guess the only other stakeholder that you have is your customer. So you have to be cautious how you deal with them. You have to make sure that they're happy, but that's the only other stakeholder that you have. You obviously have more ownership. There could be a couple of owners of a company, but you obviously have more ownership because there's no investor, so you're not giving up shares to an investor. And you're focused on profitability. You're focused on generating positive bottom line and becoming cash flow positive, because that kind of guarantees the success and the growth of your business. If you have profit, then you can allocate that profit to do more R&D work, and you can build new business lines, build new products, etc. So profit is definitely a focus. Sorry for messing up with the slides. When you're fundraising, you're essentially trading control for capital. So when investors come in, they have different demands, they have different expectations. I mean, the first thing that changes in the dynamic of your business is that the investor would most likely want to get equity of your business. So that means that, let's say if day 0, you owned 100% of your business. Day 1, if you raise $1 million at $4 million pre-money valuation, you're giving up 20% of your business to an investor or investors. And so There's an investor group now that you're responsible to respond to. But the positive side is that you have $1 million now in the bank account. Your growth could be scaled. You can now hire 5-6 developers to build a product for you quickly. You don't need to wait to sell something and then generate revenue, and then from that revenue and cash flow, pay somebody to build the product for you. You can like do it much quicker. Customers are important, but what is also important to you is now investors. Again, with investors comes quarterly reports. With investors comes regular board meetings and reports. You have annual general meetings when you have investors. You have quarterly meetings when you have investors. You send out quarterly updates prior to each meeting. You take note of all the meetings and board notes and all of that, and things become more formal. This would be positive for some, and it could be negative for some. It could be positive because it kind of formalizes the structure of your business, but it could be negative because you're worried that you're giving up control to investors. Dilution is obviously a challenge that kind of goes hand in hand with trading control. You're giving up a chunk of your business to investors. You're not really focused on profit necessarily. You're more focused on valuation. So you want to, instead of like looking at the bottom line and what remains after like all the costs and the stuff, you really care about how quickly you grow the top line, how quickly you grow the revenue, because growth in revenue and how fast you can capture market share means valuation increase, not necessarily profit. However, that dynamic might have changed over the years, but this is essentially the main difference between bootstrapping and fundraising. I guess now that we kind of have this slide talked about bootstrapping versus fundraising and the differences, I want to make sure if nobody has any questions, any specific questions about fundraising, about bringing in investors. If like you had, I don't know, anything in your mind that you were thinking, oh, if I bring in an investor, this happens or that happens, or what really happens. If you have any questions, we can talk about it. Just feel free to unmute and ask away if you have any questions. And if not, we can, if this is straightforward, we can move forward to the next slide.
I have a question about the evaluation of startups. That which types of evaluation do you use, or which one is better?
Sure. Yeah, we can talk about startup valuation. So I guess what is very important to know is that when a venture capital investor, when an angel investor comes in and tries to invest in your company, they would put together something that they call a term sheet. So a term sheet would be a legal document that kind of lays out the terms of an investment. One of the most important terms of an investment is the valuation of a company. If this is obviously if you decide to do an equity fundraising. I don't want to dive into different modes of fundraising and different instruments, but let's say you're doing equity fundraising. The most important piece of equity fundraising term sheet would be the valuation of the company. And the example that I gave was that you go in and you raise money at 4 million pre. That is usually, I would say, the number around pre-seed round, but that's not necessarily the number every time. Identifying what is a fair valuation is really based on what the market decides. So you go out, you try to raise money, you talk to investors, and they're like, oh, we think we would be investing at 4 million, or oh, we think we would be investing at 3 or 5, or whatever the number is. At very early stages, it is very difficult to come up with a formulation that tells you what should be the valuation and what is fair. There are historical numbers. There are numbers across different sectors and verticals that you can find. There's this company called Carta that manages cap tables. They put out a lot of reports every month on, let's say, What is the average pre-seed round valuation? What is the average seed round valuation? So you kind of have an idea when you're at a stage, but really depending on the type of company that you have, the number would change. And really the number kind of correlates directly with risk. So just to give you one example, if you are a hardware company pretty early on, you don't have the hardware fully built or tested out, the risk of your business is way higher than if you are a software company and let's say you're in the same situation. You have part of the software built, you have an MVP, etc. And just the reason for that is that nuances and challenges associated with building hardware is just more painful than like dealing with software businesses. And as a result, the valuation of a hardware company would be slightly lower than the valuation of a software company. Software companies could usually lead to generating recurring revenue. Hardware companies usually are one-time revenue, etc. So the short answer is it's art, not a science, especially in early stage. The long-winded answer is that there are averages in the market. Investors have seen different things. Investors have different ways of thinking about risk, and they kind of adjust the valuation based on the risk that they perceive your company would have. Somebody mentioned DC, I guess Marzia mentioned DCF. So a DCF model would be in a standard way that a finance person would do things, but there's no revenue, there's no EBITDA. So it's just, you can use discounted cash flow model, but it's usually garbage in, garbage out, because you don't really have a lot of numbers. You can extrapolate it to 10 years down the road and kind of come up with a valuation, but that is just not the way that it's done in the market. No investor would do discounted cash flow model, I would say, not up until a Series B investment. So when the company is almost profitable. Okay, I will move on the same topic to, I'm definitely struggling with my PDF. Okay, so bootstrapping versus fundraising, and this is I guess what I ask you to think about when it comes to your business. What is your timeline? Like, how time pressured are you? And at this day and age, if you come up with an AI solution and you want to like quickly build something, get to market, timeline is short. Like, new innovation comes in every second. You have to be very quick. If this is a more of a small business or a service business, timeline is necessarily not a problem. You can slowly build out a solution, a product, an MVP, etc. Then you can go with bootstrapping. It's very important to know how capital intensive your product is. Usually software is less capital intensive, but let's say your solution is to build a plant for hydrogen production, and you probably need like $40 million to build that plant. You can't really bootstrap, I mean, unless you can, but like usually you can't bootstrap building a plant. Or let's say you are a synthetic biology company, you need to produce the chemicals that you use. As a result, you need money to be able to actually build the pilot to produce the chemicals. That is not going to be cheap. It's not going to be the same cost as building software, and as a result, your business is capital intensive. If it's capital intensive, it's way more difficult to bootstrap, and you most likely need to do fundraising and go after investors. The third one is like, can you build an MVP without funding? Like, can you build me something, show it to me, test it in the market without really spending a ton of money? And if the answer is yes, it's very feasible for you to be able to actually bootstrap what you have. And then can you get to revenue early? And this goes, I guess, hand in hand with the type of product that you're building and the MVP. And if you can generate revenue from early on, if you have customers from early on who are paying for the solution, or even a mix of a solution and a service, that increases the probability that you can actually run a business that is bootstrapped, and you don't necessarily need to raise money. If any of you want to share your story, go ahead. Yeah.
Yeah, I'm sorry. We do have a question from Nihal. He says, can we raise funds without an MVP and just an idea and the incorporation certificate? And Nihal, feel free to unmute yourself. And he's added a follow-up question. I think that's just a repeat. Yeah, he's added that in the chat as well. That can we raise funds without an MVP and just an idea and the incorporation certificate?
I would say it really depends on the founder's profile. I mean, is it possible? Yes, it is possible. Does it happen frequently? I would say it doesn't happen frequently. I would say in a lot of the cases, ideas aren't worth much, and execution is very important. So being able to show an MVP is actually critical, because investors want to know that you can build a product, you can put together something, and you're able to actually demonstrate execution. And as a result, it would be very challenging to raise money without an MVP. But I mean, I can give you an example. Like there's this woman, she's a professor, or she was a professor at University of Toronto. She was the head of autonomous vehicles at Uber, and she raised, without an MVP, $80 million. So it's just like a different profile, somebody who has been in the business and as it started with an idea that she has to build a business. People want to throw money at her because they know she can do it. And that's why I say it's really dependent on the profile of the founder. But if this is the first time that you're building something, maybe you're just out of a school or you have some work experience, you have obviously a stellar resume and background and work experience, but still you haven't built a business or you haven't run an operation that is global, it would be a bit challenging to expect to be able to raise money without an MVP and just with an idea. That would be my answer. Not sure if you have. Yeah, got it. Okay. Good. Let's move to the next one. Okay, so I guess I wanted to share this example because, again, people think fundraising equates success. And I just want to make sure that you know that I disagree with that. And also there are a lot of very good examples of successful, very well-known companies that have succeeded, I guess, whatever you call success, if an exit is, and haven't raised money or bootstrapped for a long period of time and then raised something. So I guess Trello is a project management tool. If you haven't used it, if you have Microsoft Teams, I think they have an app on Microsoft Teams as well. They raised after reaching $10 million revenue. So that means that they really bootstrapped their way for a long time. This was like 10 million revenue is essentially a Series B company. So they didn't raise until Series B, and then they exited for 420 million. We will talk about the fact that if you don't raise initially and get traction and build traction and kind of lower the risk of investment, you're essentially increasing the value of the company and lowering that dilution. So you don't necessarily have to bootstrap all the way. You can bootstrap some throughout like a couple of stages and then raise money, or you can do either. I guess MailChimp is a good example. They, with $0 external investment, they got to 700 million in annual recurring revenue, and then they were acquired for 12 billion by Intuit. An example of a company that we all probably know. If you're in marketing or email marketing, you probably used it. $0 investment, an exit of $12 billion. Basecamp is another one. Basecamp, however, got a small angel check, but then after that angel check, they didn't raise anything after that. So this is also possible. You might get an investment early on, maybe very small, and this is becoming more and more possible, is that companies are getting a smaller investment initially and then they just hit cash flow positive and break even and they don't raise after that. Or Shutterstock that bootstrapped to 120 million revenue and then became a public company and IPO. So again, I just want to make sure that the takeaway is that if somebody raises funding, that's great. If you see somebody announces that they raised money, that is great. It doesn't mean that they're successful. If somebody decides not to raise money, that doesn't mean that they're not successful. They can be way more successful than the ones that have raised funding. It just depends on how you want to run your business, what you're comfortable with, and what is your outlook of the business that you're building. So don't be, I guess, pressured by the VC startup ecosystem to raise money. So I guess here, I want to pause a bit, and then like we've talked about bootstrapping, financing, a couple of people talked about their businesses. I want you to take a bit of time and think about your current funding philosophy. Are you bootstrapping because you can't raise money? Are you bootstrapping because you decided to? Do you think you should raise money? Think about if, I don't know, if you have 500K today, would that change things for you? Or no, you don't need that 500K. You can build your MVP and build your product. Let's think about this for a couple of minutes, and then I would love to, if people can jump in and share a bit more about what they think. And feel free to unmute and jump in as soon as you want to share what you want to share. Anybody has anything to share? Do we want to discuss anything? I guess while you guys try to think of your story and unmute, I can tell you a story of a friend of mine who decided to bootstrap. So I have a friend who immigrated to Canada in 2015. His background was game development. He started in just building games. He thought that he could actually change the world by building games for different consoles. Then he went to school. He studied architecture. He immigrated to Canada around 10 years ago, and what he thought was that he can actually mix his game design and development skill sets with his architecture knowledge, because I guess real estate at the time was booming and is probably still booming in Canada. And so he thought he could mix the two skill sets and experiences and build a product to visualize real estate development projects. So if you're building a real estate project, you want to make sure that your customers, the ones who want to buy the property, can see and visualize what the outcome would be. And so my friend decided to actually build a solution like that. And so he started working on it on his own. He didn't raise money. After around, I would say, 6 years and making a lot of mistakes and getting out loans, he took the company to around 2-3 million. Now the company makes 2.5 million. The company's cash flow positive. He was very adamant that he didn't want to share the company with anybody else. So he didn't want any investors. He didn't want the involvement of anybody else. He thought that he had a good idea of how to build the business, and he didn't need anybody's support either. So that is one example, like somebody who decided to bootstrap the business throughout its life cycle. that at least I knew of. What do you guys think about that? Do all of you want to raise money? Do you hate raising money? Do you have any questions about raising money? We can talk about that as well. Any volunteers? Can I call people out, or that's not nice? I should wait until
No,
somebody
we
raises
get
their.
something in the group. And guys, you feel free to drop in messages in the chat if you feel like you don't want to unmute.
If you're shy, you can write down your messages. Yes.
Yeah. Awesome. I don't know, Moin, if you can see Basim's message in the.
I can read it.
Actually, I want to participate to tell my opinion about it. Actually, the sharing the shares in the company or giving other people some share in the company, depending on the business itself. So some businesses you need to get some fund support from other investors. Some other business maybe doesn't need much to invest to develop it. But most of the people, when they open any project, they fall in love with their project. They want to own it. They want to hold it. They don't want to share it with any other people. That's thing. It's like looking to the things from very small angle. They don't see the whole picture of the business and investment. So most and better way for the business to share with other people. Sharing with other people make the business bigger and growth in very fast way if you have correct plan and if you have some good idea and good type of management of your business. This is my opinion actually. Always I would like to, when the business is successful and you have opportunity to promote it and share it with other people to funding your business and have share in your business, it will help you to get more profit at the end of the day. This is my view to the things. Don't know if
Great.
it's will be correct from some way from other kind of business. No.
Yeah, and I run another workshop with Innovation Cluster that where I have a couple of slides that I show. I try to demonstrate how a cap table or ownership of a company would look like over time as it receives funding. And one very important thing is that day zero, you have a very small pie. You might own 100% of it. But then as time goes by, as you build the business, as you bring in investors, the value of your company increases. Your share of the pie is decreasing, but this pie is getting bigger and bigger. So day zero, you own 100% of nothing. But then after you build this business to 100 million, you might own 25% of it. But that equates to $25 million in value. So bringing in investors for a lot of businesses makes sense. And we would discuss this. It's not just the money. It's not just giving up the ownership, but it's a lot of guidance and network and support as in addition to the money. And that's where raising money also makes a ton of sense. But I do agree with Jamil. We have, I guess, a message from Basim. I can read that. The question is, how can a startup assess if their startup is genuinely ready to generate revenue versus falling into the trap of monetizing too early and potentially compromising product market fit or long-term growth? I guess when I read the question, there was an example that came to my mind. And so I guess to explain the question, if you're starting with a product, sometimes there's an opportunity for you to monetize the product early on. There's a customer, somebody comes forward, I think one of you spoke up. There's a customer that comes forward and asks you something and you're like, oh, there's a customer, that's great. This is probably product market fit. I will build this product for this specific customer because they seem to like it. And then I guess the trap that you're in is that you build the product, you're convinced that there is customer for it, and you kind of rely on that one customer pool and you build the whole product around that. And then as you go out to the market and you talk to more potential customers, you realize that is actually not what people want. That was just like what one single customer wanted. And I guess there's no easy answer, but I would say it's always great to monetize. It's always great to think about generating revenue and selling something. But I would say be cautious if you're selling something to one specific customer. Don't build the whole product around one customer. And definitely as you're building a product around one customer, make sure that you get feedback from other customers as well, because getting approval from even a couple of logos is not enough to make sure that you've reached product market fit. You could still build the wrong product if you don't do proper research. So I guess from a product management perspective, you need to make sure that you've done enough market research to ensure that if a customer comes forward and you're building something for them, you're not too early relying on one data point, and you have considered several data points. That is a good question, but definitely not related to fundraising and versus bootstrapping. We can talk about bootstrapping and fundraising as well. I will just go through a couple more slides to make sure we get to somewhere meaningful before maybe a 5-10 minute break. But then I will make sure to also leave some time at the end to just ask away any questions that you might have from somebody who works in the Canadian ecosystem as an investor. Okay, sorry. This is, I guess, I kind of touched on it a bit. I want to talk a bit about this freedom versus the scale. This is where the compromise is happening. What is it that matters to you? Do you want to make sure that you capture market share very quickly, or do you want to make sure that you don't give up ownership? That's essentially the freedom versus the scale. With fundraising, with venture capital, there is aggressive scaling expectation, and here is when it becomes a bit dangerous. When you raise venture capital money, the traditional expectation is that you at least double the revenue year over year. The expectation is very high. You burn a lot more cash. You kind of jump on this hamster wheel of, I raise money, I grow the company. If I don't hit this milestone, I can't raise money. So I have to you're just constantly in a loop of, I have to double the revenue to be able to raise money for the next 12 to 18 months. I have to double the revenue or triple the revenue to be able to successfully raise my Series A. Again, I have to triple in the next 12 to 18 months to be able to raise Series B. This just continuously happens. And if you fail at any point to grow, you don't, because you haven't built the bottom line, because you haven't built the profit, you run out of money and you essentially hit a concrete wall and you stop because you don't have money, your business stops, and it essentially fails. So you need to catch up with the expectation that investors have. And in the venture capital world, investors invest in I don't know, let's say build a portfolio of on average 25, 30 companies. 50% of their companies are going to go to zero. They're betting on high performers. They're betting on those who would become 100x. They're betting on what they call a power law model. They want to make sure that at least a couple of these investments get to 100x plus, and then they're able to recoup their fund. So it's the scaling expectation is very aggressive. It's essentially either a scale, or if you don't scale, you fail. That's the outcome. And this is completely opposite of you growing through bootstrapping. You have a small team, you have a lean team, you don't have any pressures from anybody. Again, you build whatever you want to build, and nobody can dictate where you go. Great. And so I wanted to kind of show this to you just because I found it very interesting, is that you have big name companies. You have Shopify of the world that is public and IPO. Then you have MailChimp of the world that has been acquired for $12 billion. And you have kind of in between companies where they have raised a bit of money, bootstrapped a bit. And so in that freedom versus a scale kind of, I guess, spectrum, they're one side or the other, but these are all very famous names and these are all very successful names. I would say you definitely are not locked in anywhere. You can start with the freedom and then raise money after. You can start by raising money like Trello did, like Basecamp did, and then not raise anything after that, and like keep that freedom for yourself. So it's not black and white. It's definitely gray. And I guess this is something that I talked a bit about as well, is that funding is not just a check. If you have investors, you don't have investors because they just come in and put in $1 million into your business and take a chunk of it and then ask you for reports. What I tell people is that there's definitely a lot of money out there. You can get money. If you're building a good business, you can definitely find investors. That shouldn't be a problem. But what is difficult to find is an investor that is a good fit for the venture that you're building. So somebody who's able to provide strategic advice. So investors often, they bring in industry knowledge. They might have a network of advisors within their fund who can come in and support you. Investors definitely have large networks. So in their networks, you could ask them, hey, can you help me find a solution architect? Or hey, can you help me find a salesperson? So these are definitely value adds that investors can bring in. Sometimes, not oftentimes, I would say they bring in credibility as well. When you're backed by an investor, there's a press release. Other investors see you as a company that has raised money. Enterprise customers see you as well. So there's a bit of PR as well when you raise money with an investor. There is definitely accountability and pressure. Sometimes that's a good thing. Those regular check-ins, the KPIs that the investors set for the business, they push the business to be more focused and grow and kind of have a formal process. While a lot of times when the business doesn't have formal investors, they're just scrappy all the time. They don't have formalized processes. They're just getting by. And then lastly, a lot of investors have access to legal, financial, recruiting, etc. support, and they're able to provide that as well. And just, I don't know, to give you one example, in our fund at Green Sky, when we invest in a company, we definitely are on the lookout to see if we can help a company with applying for grants. If we see a grant opportunity, we definitely introduce them to that grant opportunity. We try to have conversations and negotiate with recruiters and kind of get a discount for the companies that are in our portfolio. When there's a legal conversation that requires advice, we have a law firm that works with us at a discounted price that we are able to introduce to the company. When the company wants to exit, we have managing partners that have experience with exits and exit conversations, so they could come in and have that conversation or support the CEO when it's the first time that they're having that conversation. So these are areas that investment would bring in. It's not just a check. It's a lot of different type of support in addition to that investment. And I thought this would be an interesting example, is that like Calendly, they bootstrapped for years. They hit 100 million ARR. The reason that they actually went out for a strategic M&A was to expand their go-to-market strategy, for example. Like they didn't need to do that, but that brought in an additional kind of boost to growth. So I guess if you think about your business, what do you need beyond, like, obviously, let's say you need cash to grow, but do you need PR? Do you need credibility? Do you need connections? Do you need support navigating, I don't know, a legal framework or something? What is it that you need? Just because funding is not I guess the goal is to treat funding as fuel. It's not validation, but it also unlocks other things, and it's not just a check that hits your bank account. I will pause here before, I guess, prioritizing revenue. Just want to make sure if you have any questions about like the value adds that you should expect from an investor. And again, we have another workshop where I have a specific slide that I share with attendees, which is what are the questions that you should ask the investor that you talk to, and here I guess is an example there. Let me know if you have any questions. I will.
Guys, please feel free to drop your messages or your questions in the chat or unmute.
Okay, sorry. The room that I booked had another booking overlap, so I had to move. But okay, so no more questions here. We can move on to prioritizing revenue. And I think I promised you guys to have a break in 20 minutes. But yeah, let's cover this as well, just because it's very important. When you decide to bootstrap, when there is I guess money not coming from investors, then one of the most important things is that there's revenue coming in very early on, because that revenue kind of gives you the fuel to move forward, do more R&D, build a product, etc. So you kind of think of all the ways that you can generate revenue. And there are reasons that I would say, even for a startup that decides to raise money, prioritizing revenue is key. And this is usually something that startups forget. And the example that I gave is that like the startups become grantpreneurs, where they just apply for grants and try to like secure grants, and that they would give them the runway, or they would just become amazing at raising money. They're not amazing at generating revenue. So if you prioritize revenue early on, that means that you're trying to get validation from customers early on. Like making customers pay is very, very key and very important. There are a lot of times that us as investors, we talk to startups and they tell us about an unpaid pilot, a test with somebody, or interview with customers. So a lot of times when customers interview, they give you positive response. A lot of times when you have unpaid pilots, it's positive. But until you see the revenue coming in, until somebody starts paying for the product, you can't really be sure that there is that validation, because a lot of times customers like the product, they're like, oh, we like it, it's interesting, but then when it comes to paying for it, they're like, okay, this doesn't make sense, you're not going to pay for it. That's essentially the key here, making sure that you get that validation early on. And if you prioritize revenue from early days, that would be possible. And again, sometimes you're like, I don't have an MVP, I don't have a product to start generating revenue. What are the ways for out there for me to start generating revenue? I would say, even if you can start providing your solution, your product, in a manner of consulting, in a manner of service, but have customers appreciate the value that is generated from that service, that is still very important and very valuable. So if you can start a consulting agency and then build a technology and product on top of that, you're essentially getting confirmation from customers, you're getting validation from customers, and then you're building the technology on top of it. Prioritizing revenue gives you leverage. If you have revenue, you have optionality, you have money coming in from your customers. You're not forced to raise, you have the option to raise. So, and the best time to raise money is when you don't need money. If you don't need money, if you're not desperate for raising money, then you have an upper hand, then your valuation is higher, then the dilution is in your control, then you have the control of the company and you can define a lot of the terms. But if you don't have revenue and you're just going out to raise money, then you don't have a lot of options. So being able to negotiate, being able to set the terms for around when you have revenue is completely different from when you have a product and you don't have revenue, you don't have a lot of traction. I guess I think when you start generating revenue, even if it's a small amount, that gives you a lot of energy and proof for what you're building and kind of moves you forward. Um, I guess we had a comment about like getting into the trap of dealing with one customer and building a product around that one customer and not hitting product market fit. That is definitely there. But like if you generate revenue, it is most often positive than not. And again, yeah, if you generate revenue, it is essentially becoming a real business. It is not a science project. It is not a fantasy. You've now started creating something that is adding value and people are willing to pay for it. And I think that's the most important thing about building a business. Again, the message that I want to deliver is that a lot of people start their idea, they go ahead with an MVP, they want to test it. They don't think about what is the first thing that I can do to generate revenue. They think about what is the first thing that I can do to raise money. And I want to make sure that you prioritize generating revenue more than raising money, just because it would give you the fundamentals to build a business which is sustainable. But if you just prioritize fundraising, you're not necessarily succeeding or successful at building a business. I have a list of, I guess, questions that I thought you should ask yourself. And these are the things that would be very important when you're prioritizing revenue. And I guess these are the questions that you would ask yourself when you're thinking about your product anyways. Is that, what is the problem that you're solving? Is it a urgent, painful enough of a problem for somebody to pay for it? Or this is just like a nice to have product that can be replaced or can be ignored, etc. We use a term is to say vitamin or a painkiller. You can probably drop a vitamin and not take it, but if you're in pain, you definitely want to take a painkiller and you're willing to pay for it. Is there a way to test monetization before investing anything into the product? Again, my idea for testing monetization is usually, can you turn it into a service? Can you turn it into a scrappy product? Can you start generating revenue by not having a product and kind of instead doing the thing that you want to do with that product manually and test the market? Sometimes that's feasible. Sometimes that's just insane. That's not possible. If you have to build a sensor that needs to test X, Y, and Z and needs to get regulatory approval, obviously that's not possible. But where possible, think of ways that you can use to see if monetization is possible. Again, do you need to build a product? Can you get away with developing a minimum viable product so that you're investing less money into it? Has anybody else done this before? Can you learn from people's mistake? I think that is the one that I really like. And to give you one example is that I've seen, this is like a real story. Like there's a startup trying to build a solution, let's say for the building industry. There are, let's say, 5 other competitors in the market in North America. By going and talking to potential customers, other investors, this one startup realizes that the competitors have a big problem. All of them have a problem in scaling up their product because the product is very challenging. Or all of them have a big problem in scaling revenue because revenue is one time and it's project based and it's not recurring. These are the things that you can learn from somebody else if they've done it. So if you have a competitor, that's not always scary. That's sometimes a very good thing. And you can just learn from them and not make the same mistakes that they've made that led to, let's say, their failure. And I guess, yeah, just when it comes to the last question or the most important question is that if like with everything you have today, is there a way for you to generate revenue? Like that is a very important question. Like with everything that you have, can you provide a service? Can you do consulting? Can you do something that generates revenue to gives you a hint that the product that you're working on and the plain pain that you're working on and the solution that you try to provide is actually the one that people would pay for. And again, that could make your progress slower because you're trying to prioritize revenue generation. But I would say in a lot of examples, it would give you more leverage in building a better product and building a better solution just because you have started prioritizing understanding what your customer needs and specifically building something that your customer is willing to pay for. Just because I was talking constantly, I want to make sure that some time. Okay. I guess maybe we can pause here, take maybe a 15-minute break, and then come back and talk about this specific. Are people paying for a solution to their problem right now that is, let's say, slower, more expensive, and clunkier than what you're envisioning to build? So that would be an easy way to think about it. If there's a solution right now in the market and you're building something that is faster, better, cheaper, then there's a high likelihood that people would pay for it. If there is a problem in the market that there's really no solution to it and you're building something to target that, I guess the easiest way would be to prioritize revenue and see if people would actually pay for it or not. Otherwise, if you were just to assume that there's a problem, I think people would be willing to pay X dollar to solve this problem. Might be just a speculation. But if I guess any of you have tried it before, if you have tested that, I guess one of the participants mentioned that they built the product because a customer reached out. That's usually a very good sign. But if you have any experience on like gauging customers' interest in paying, why don't you share a bit more with us? Any volunteers? Or if you haven't gauged the customer interest, tell us what is your plan to gauge the interest of your customers and see whether they would pay. Anybody interested?
I do
Jimmy?
see something in the chat.
Sure. Okay, somebody shared of the opinion that unless business brings value to customers, then people would be certainly willing to pay even a premium as well. And then we have, you're trying to build a solution for people which they love and willing to pay. Hope so. And I guess that the point is to get confirmation and see if they would actually pay for it. Again, even if it's a small amount, even if it's $100. I guess one example is that when Tesla launches the cars, and nobody before even building the cars, they open up their web page and they're like pre-register for this car and then put in $100 deposit. And so people would rush into the website, put in $100 deposit. It's not a lot, but it's $100 deposit that helps them gauge something. And I think what I want to make sure is that you guys think about it in the way that, okay, can I gauge the interest beyond just somebody registering for email service? Can we also have them pay for it? That's essentially it. Cool. Let's I guess dive into our next topic. Obviously, whether you bootstrap or not, capital efficiency is very important. One very important factor that I see across a lot of startup companies is that they make a bunch of different types of mistakes when it comes to spending their money, which leads to them then running out of money very quickly. And so I try to like list a bunch of these items here. I tried to list a bunch of items here that we can go through together. One area that like leads to burning a lot of cash is just like hiring mistakes. So either you hire someone too early, or you hire someone at a very senior role. That these are some of the mistakes that are very costly. I guess one saying in Silicon Valley is that hire fast, fire fast. That is a very detrimental advice, especially in Canada. You can't hire fast and fire people fast. There are legal precautions associated with that. So if you're hiring someone, be very careful who you're hiring, when you're hiring them. And one of the very important things is that when you hire someone, don't just throw out C-suite titles. Don't just tell someone that you're going to be the COO of the company. Have them as an operations associate, have them as a consultant, let them work with you a bit before really giving them the title, because there's really no way up from a COO when you hire a COO. And if you do it early on, and if that person is really not growing in the role, you have to let them go. If they have the title of a COO, that is not going to be cheap. So think about, when you're thinking of hiring someone, think about having contractors, freelancers, etc., versus full-time. Marketing, I've seen a lot of examples of companies spending big dollar for marketing before even having a product or before even having product market fit. They essentially want to fake it to make it. Sometimes it works. I would say most of the time it doesn't work. Like it's really outrageous for an early stage of startup to spend $50,000 on branding and marketing and Google ads and Facebook ads and etc. before really having a full-fledged out product, before having like organic customers using the solution. So definitely don't do that. Product and development, sometimes over engineering is costly. We've had companies that we've invested in where the product was over engineered. It was just, they built so much features that was not even used, and that's just an example of over engineering an area where cash was burned to build a product that is not being used. Office and tools, this sometimes burns cash. Again, goes back to that marketing spend almost, is that people are like, oh, if I have a 5,000 square office with this fancy view, then customers are going to just come in and pay for my solution. Just be careful about that mindset as well. A lot of times early stage of startups don't need anything. Like they don't need a space. You just need your laptop and that's it. You can sit at a Starbucks and work. You don't necessarily need to rent an office, or you could use innovation clusters, shared space that is affordable. You don't need to have a lavish, fancy office at all. And then lastly, legal and finances. So I would say legal fees could really add up. Like a law firm partner hourly rate could be, I don't know, $500, $600, $800 an hour. You have them on a Google Meet call for half an hour, that's $400. You get their opinion for something, that's another $200. Every 6 minutes they charge you. So be very careful when you're dealing with lawyers. Definitely initially at the beginning of business, make sure you don't spend a ton of money on contracts and stuff. I mean, obviously in some occasions you have to, you don't have any other way, but don't use a fancy law firm, use a smaller law firm, use a more affordable one that works with the startups. A lot of the Canadian law firms have a startup programs where they just charge you $5,000, do a lot of your work until you raise money, and then when you raise money, they would charge you after that. But like before you really raise money, you don't have to pay them a lot of cash to put together your shareholder agreement, etc. So yeah, think about what are the things that you need now and what are the things that can wait. And if there are things that can wait, definitely don't spend money on it. How to stay lean without stalling growth? That is the other question. Like a lot of times companies are like, oh, if I don't spend money here, it's going to be slower. But I guess what I want to make sure the message is that if you're scrappy, you don't necessarily sacrifice growth. So instead of hiring full-time, let's say developers, you can use a lot of the freelancing solutions that are out there. You can use a lot of open source tools. I mean, I would say a lot of time, even spending $25 a month for a Gmail account instead of using, I don't know, a kind of an open source email, that could save something, even if it's $25 a month. You can automate a lot of stuff with no code solutions that are, most of them are available or free or open source. Definitely delay big hires. Use fractional solution providers, like instead of hiring a CFO, you can get away with hiring a fractional CFO. If you need a chief product officer, you can get away with hiring a chief product officer that is fractional and is not doing the work full time. Think about that as well. Like a lot of these C-level roles that you think might be necessary for your company, you can hire them fractional. You can think of negotiating the pricing that you're paying for tools. A lot of the, I would say, regional innovation centers, for example, in Canada, they have agreements with AWS, with Google, with Microsoft Azure, with HubSpot. So they give you credit for a lot of different things. And when you get credit from them, like the AWS startup credit could be $100,000. You don't really need to buy cloud computing, whatever credits for a year or two. So you could definitely be scrappy in those situations. And then oftentimes you can negotiate with shares. This is definitely a way that I've seen a lot, and it kind of works. You can have somebody work for you for what we call sweat equity. So instead of really paying them, you can have a developer convince them that instead of paying them, you would pay them the shares of the company, so they take ownership of the company. Again, goes back to your philosophy of whether you're open to sharing what you have with others, or like compensate people via shares, or sorry, I went back to slide 0. Or you're okay to actually, that was so many slides. Okay, or you're okay to actually give them shares. That would be definitely a way that I've seen works a lot of times. Like you've definitely heard of a story of somebody who came in to paint, I think, Facebook's office. They didn't have cash. They gave the guy shares, and it ended up being like however $1 million or $1 billion. So that's definitely something that you can do. And so again, this is something that a lot of the companies I see miss, is the idea of running lean, but not slowing down, and like having a good grasp of where the money is being spent. So a lot of founders, if I ask them on a monthly basis, on a weekly basis, how much money they're spending, they just don't know. Like it, obviously, when you start also burning cash that is invested dollar, you kind of lose track of things. So making sure that you track burn on a weekly basis, you know, how much dollar went for your email service, your cloud service, your marketing dollar, etc. All of that is very important for you to be able to stay on top of the business. This is a good principle to run experiments and not projects. So validate things with a small tests and then build things. If you can have a landing page and a wait list and a pilot, that is way better than building something and then going out and testing it, and it's much cheaper. So if you can do that, definitely that is a good mindset of staying lean. Review what is working and what is wasting and what is not working. I don't know if you have, this is again something that we're dealing with right now, and I've seen happen a lot of time. Company rents an office, there are 2 rooms staying empty. Can they actually rent out those 2 rooms or not to kind of lower the burn, or do they actually need the whole office, or can they share the office with somebody else? These are just like examples related to office, but there are a lot of different things that are like that. You've hired a freelancer to do the graphic design work for you. They're continuously charging you, but it's not efficient. Make sure that you spend the time, kind of review their work. If they're not, if it doesn't work out for you, they should definitely go. And then being lean doesn't mean to starve. It's definitely, what is important is to spend money where there is the highest amount of impact. I mean, search engine optimization, for example, is where you spend the money, you get the return on investment. Building community, kind of building your brand to do the sales. These are the things that you should consider spending money for, because these are the main drivers of the business and can bring in revenue. So the parts that are driving value, the parts that are generating revenue or value, you should feed those. And the parts that are not really adding value, the parts that are not generating revenue, you should cut them. And this is a question for you. Like, what is one thing that you're spending today that is not necessary and you can cut it? Like, I don't know, you might have a subscription that you're like, why do I have this subscription? I can cancel it today. Or you might be using a freelancer and you're like, this freelancer isn't doing the work, or they're producing these graphics for me and I'm posting on social media and I'm not getting anything out of it. Should I continue or not? What are the things that you're seeing as you're running your business that you think are just unnecessary costs and you can cut them? Or what are creative ways that you can find to kind of, instead of paying people, give them shares, kind of deal with the compensation in a way that it lowers your burn, and also makes other people kind of responsible toward helping you building a successful business. If you give somebody shares, hopefully they would be motivated that those shares would turn into value, and then they're able to, at the end of the day, get the upside. And so as a result, hopefully they would do the best they can to support you, and they have a bit of a skin in the game as well, and they're not just coming in to get paid. But I think this is very important to think about items that you're overpaying for, or you think you're going to stop, just to make sure that you're running a leaner operation. And I'm sure you can find it in your day-to-day. You're probably paying a subscription for Netflix or something that you're like, I'm not watching Netflix. Why am I paying like $25 a month? Or there might be something that is out there. Who wants to volunteer? If nobody volunteers, that tells me that every one of you are running a very lean operation. Okay. Anybody interested to share?
I see some answers popping up in the chat.
Okay, so Shomi shared that we have just realized that we are probably spending more on marketing efforts, and it may be more effective to get some test inventory and clients to gauge interest. I guess one of the items that we had was like spending too much on marketing when it doesn't really add value. SB said that they are running a lean operation for the time, so that's great. There's no fat to cut there. Everything is lean and smooth. That's awesome. Cool. And yeah, feel free to share if anything comes up. I want to make sure that I'm on track with time and I'm able to go through all the material. So I'm gonna push ahead, but if you want to share something, please stop me. Okay, cool. So one of the, I guess, ideas that I talked about was instead of hiring, outsourcing. That is definitely something that helps a lot but it becomes, I guess, a scary, or it becomes important at points for someone who's running the business to think about the way that they're doing things and the way that they're thinking of outsourcing. So if it's simple stuff, if it's design, if it's web development, if it's branding, there's really no intellectual property. There's really no harm to outsourcing that. You don't necessarily need somebody who's very expensive, somebody who just brings things together and makes them look good. That's good enough. You can outsource it. The cheapest option would probably work at the earliest stage. But if you're talking about core product, if you have a hardware that has a specific firmware and somebody is developing the code for that firmware, and that's your unique value proposition or unique IP, that is definitely something that you should be very careful about outsourcing. If you're outsourcing to a different country, you have to think about that. If you're outsourcing within your jurisdiction and country, think about the ways that you can sign NDAs and like protect the IP. We don't want to dive into the topic of IP, but that is an area that you should be more careful. Again, if it's marketing campaign, you can get it outsourced. Like somebody can create content for you, can even post to social media, send out email campaigns. So these are the areas that that you can outsource. But then if it's dealing with customer support, I wouldn't suggest you outsource that. If it's your customer, early stage, definitely the CEO should be the one talking to the customer and nobody else. But then as the company grows, you should definitely have in-house team talk to the customer, unless you're just giving up all the sales process to an outside group or a partner group. I wouldn't suggest outsourcing customer support. Again, simpler tasks like admin, bookkeeping, those could be outsourced. But then things that are more crucial, like fundraising or investor relations management, those could not be really outsourced. If you're going out for fundraising, you can't have somebody else go out and fundraise for you. If you're the CEO, I would say even the COO can't go and fundraise for you, or even other C-suite people cannot go and fundraise for you. You should be the one fundraising, and you should be the one managing investors. And again, if it's one-off things, builds and pilots, you can outsource. But if it's a vision, if it's a leadership, if it's the core strategy, you can't just like bring in someone and tell them, hey, help me on the core strategy. That just doesn't work. And again, on the topic of hiring, that first hire can be very, very important. The first people that you hire into your organization are important because they set the culture, the habit and the way that they work. They kind of set the tone for the rest of the team. At early stages, make sure that you don't just like hire similar people. I had a friend who was a serial entrepreneur and told me that one mistake that he made was that he hired people who were mostly in their 40s and 50s in his first business. And then he realized that he needs to mix and match people who are from a younger generation and are less experienced, and not just have people that are very experienced, because there's like a different perspective that comes into the team. Or you, I guess the other way to say is to make sure that like people that you hire have complementary skills. Mission, utility, these are very important, especially for a startup. The person that you're hiring needs to know that this is not a corporate job. Things are very challenging. So definitely think about that when you're hiring. And again, think about the cost of hiring. When you're hiring someone, it's not easy to get rid of them. You can't just like hire them and then fire them. That is very costly. And that's why this is a very important topic for bootstrapping and financing and managing your finances. And then the last thing is that I would say avoid giving high-level titles to employees, because again, the problem is that somebody comes in as a COO, they won't grow with the role, and there's no way for you to promote them. But then they are also not doing the work as a COO, and you have to bring in somebody as a COO. That is another area that would cause a lot of challenges, a lot of inefficiencies and you have to get rid of the person, which would cost you something. So I guess, yeah, some mistakes to avoid. Definitely, initially, if you don't need a CMO, CFO, don't hire them. Make sure that you don't have generalist, high-level people that like talk the startup talk, but then don't do the work. I've seen that a lot, where like you hire someone, they talk all the startup-y and exciting and interesting, but then when it comes to doing the work, they don't want to do the work. They want to just like give orders to other people. This one is a bit tricky. Definitely think about when hiring friends and family. It's hard to fire. It would create drama, etc. So definitely be thoughtful of that. And yeah, definitely if you can not hire people full-time initially and have a probation period and have them join as a freelancer first, that would be the best. Not possible all the time, but that has really worked the best I've seen. Again, on managing hiring and managing kind of the HR side of things in order to lower your cost, definitely get advice from a lawyer. Make sure your employment agreement is solid, and this is an area that you would lose out a lot of money if it's not. So if your employment letter is not solid and you dismiss someone, they could come back and sue you for unfair dismissal or for a wrong dismissal, and then you have to at least pay them a couple of months of salary. That is like what I'm describing is like at least 20K in lawyer fee and 40K in the fees paid to the employee. That is a big chunk of cash given to someone because you didn't do your work as a CEO in putting together or making sure that you have an employment agreement that is solid. That's definitely important. And again, goes back to that cash reserving things. Define a probation period. Probation period allows you to like get rid of someone without a lot of consequences. So definitely have that. When you're hiring someone, make sure that you can afford to hire them. You can afford to pay their salary. If you don't pay them, especially in a lot of places, especially in Canada, directors, so you who runs the business, you could be personally liable for their salary. And again, this is a deeper topic. You can talk to your lawyer about it when you start hiring people in Canada, but this is very important. You can't just like hire people and then don't pay their salary. They can come after you personally and your own personal assets. So this is, again, this is a life lesson and a business lesson, I guess. So these are the legal risks to watch for. And again, legal risks directly mean cost to your business. Make sure that you're aware of the employment law. Obviously, you need a lawyer. You can't just figure out everything yourself. Definitely make sure that you have things signed. A lot of times in Canada, verbal commitments are commitments. So proving a verbal commitment or not a verbal commitment could be painful. So definitely make sure that you have things signed and agreements are in place. Firing is not free. You have to like pay the lawyer. You have to pay the person. Unpaid salary has liability, and then IP ownership is one that is also very important in the contract that you prepare for employment. What is common is that you make sure that everybody who comes and works for you, they assign the right to the intellectual property to the company. You don't want somebody to come work for you and then take the piece of IP that they've generated with them. Obviously, you're paying them, so the IP should remain within the company, and that could be a costly mistake because then a big moat and a big important driver of your business success could leave your company. Okay, I want to pause here because I have a couple of slides on raising and like when you should think about raising. So want to pause here, make sure there are no questions about hiring and a strategic hiring. Any questions? Anything that I said that was new to you? Anything that I said that you knew? Cool. I'm assuming there are no questions, but if you have any, you can shoot away. We can talk about, sorry, we can talk about fundraising. So I guess this is this becomes very important when you decide that, okay, bootstrapping doesn't work. I need money. I need money to build my business. I need money to grow, etc. This becomes very important. But one of the questions that I get all the time is that when is a good time to raise? And I think there are some signals that can tell you whether this is actually a good time to raise or not. So the first one would be you have validated the business, you have customer, you have a revenue. It might be still early on. You might have, let's say, a couple of $100,000 in revenue, or like you might have a couple of customers. You can't necessarily say you have product market fit, but at least there's a pull from the market, and you seem to be getting some signals from the customers that they like the product that you're building or the solution that you're providing. So you have early traction, value prop, and retention or conversion. These are the signs that like you can definitely raise money. You understand the core metrics, you understand what you're selling, the business model is more or less formed, etc., or like you at least have an idea that what the business model or the core metric could be. And then the last one would be you've exhausted organic growth. This would be a good step is that you have if you have received a bit of money, or if you have like bootstrap from the beginning, you see that you really need a bit more cash to be able to, I don't know, hire some people. You really need cash for marketing. You really need cash to expand to a different location. So go beyond that organic growth. That would be, again, another good time for you to raise money, because you've kind of proven that organic growth is there, and now you want to go above and beyond, and you want to raise money to be able to actually achieve that. We kind of covered these at the beginning as well, when we talked about bootstrapping versus financing. But like when you're raising, you kind of face a timing pressure. You're like, oh, this is the opportunity of a lifetime. I'm building this in the next year, or like there are 4 other competitors building it. It's a land grab situation. I have to go into the market with a product very quickly and expand as much as I can. That is kind of the time pressure situation, and you're like, okay, I need to raise money. I can't bootstrap. I can't drag this along. You have a growth opportunity that you can't capture without capital. This could be you need to build a larger sales team. You need to build a larger tech team to build the product that you think that the market wants. So again, you're kind of digressing from that organic growth into kind of a more accelerated growth, and that's why you need money. You can map how investment would convert into growth, and I would add that you need to know how much money you want, where you're spending the money, and what would those spends give you in terms of milestones. So for example, you know that if I'm raising $1 million, it would give me enough runway to complete my product. It would give me enough runway to even bring in enough customers to generate $300,000 in annual recurring revenue. And it would allow me to hire 5 new employees and get my team to like 7 people or whatever it is. And then at that time, let's say after 1.5 years, I am ready to raise a $3 million round. So that it should be driven by, I spend X dollar to achieve Y. And as a result of that Y, which are the milestones, I'm able to then raise a follow-on round. This happens sometimes, is that you're not raising, but investors reach out to you. That's also a good sign. I've seen that a bunch of times. I've seen that for companies where they were at like $10 million in revenue, and then investors were reaching out to them and they were proposing to the company to get money from them. That's a great place to be in. But yeah, if that happens, you definitely is a good time for you to raise. Before diving into the type of capital, does anybody have any questions about like fundraising in general, when to think about fundraising, how to think about how much money you need to raise? If not, we can talk about the type of capital options that you have. So again, we're not diving into fundraise. This is not a fundraising 101 kind of workshop. It's more of for you to better understand the ways that you can bring in extra capital to your business other than the revenue that is being generated or your own investment. So you have angel investors or strategic VCs. Those would be the two type of capitals that you could use externally that could come in, get a chunk of your business, and give you runway for you to be able to build a solution, expand sales, etc. Main difference is that angel investors come in early, VCs come in a bit later. Angel investors write smaller check sizes, maybe 20 to 100K. VCs write larger checks, maybe 250K to a couple of $1 million, depending on the stage. Angel investors are usually quick and agile in making the decision, and VCs are slower and they take their time and do a deeper dive into diligence, but they can usually add more value. Beyond angels and VCs, we have government grants, especially in Canada, in the US. You have different institutions that have different types of grants for different R&D driven projects for the private sector. So in Canada, you have industrial research grants called IRAP. You have tax credits called scientific research and experimental development, also known as SHRED. Here and there, depending on what you're working on, there are grants. And the good thing about them is that they're non-dilutive, they're non-repayable. You get them from the government to hire folks, and you don't need to repay it back, and government doesn't take a chunk of your company. So that's probably a good way to also boost your bootstrapping activities. There's revenue-based financing. So this would be a form of a debt where lenders could come in and finance your business based on the revenue that you have. So it's essentially a debt or a venture debt, I guess. I would say just be careful when you're dealing with debt, because there could be personal liabilities as well. And then lastly, they're usually incubators, accelerators also provide a bit of capital, usually pretty small, but it's kind of an initial, like pre-seed, usually inception level kind of capital. I don't know, in Canada we don't have Techstars anymore, but we have Antler that provides 100K at the inception level. Yeah, there's YC, there's Techstars in the US. They provide kind of the same funding as well. I have another exercise. I've had I guess a bunch of different. We went through the type of investors. We went through what to think about when you're thinking about raising, when to raise. But I'm wondering what kind of investors would I want in the room with me during hard decisions? And this is actually a very important question. Usually, because when you start building a relationship with an investor, it's a very, very long-term relationship. We have companies in our portfolio right now that have been in the portfolio for the past 8 years. We at least interact with them every quarter, so it's a very long-term relationship. If we don't have a good relationship, or if we disagree on stuff, it would be very challenging to manage that dynamic moving forward. So I would say think about this. Think about what are some of the folks that you want to support you.
I see Basim's already posted something in the chat.
Yeah, I can read the question. So the question, or the mix of question and comment, is that with angel investors, there's always debate over loss of control and dominating decision-making power and company culture. So the question is how to limit the risk, if I may say. So I would say when you talk to investors, there are a bunch of things that you can ask them to better evaluate them. One is that you can always ask an investor, can I talk to other companies that you have invested in before? That essentially you're doing your own due diligence when you're dealing with an investor. You would have a conversation with a startup they have invested in. You would have a conversation with a startup that they are sitting on a board of. That would give you the perspective, hopefully, the perspective of that startup and how the interaction with the angel was. That is one way to do this. But also, I would say you don't pitch to an angel once and they get to the decision-making process. Usually, it's a bunch of back and forth. And I think spending time with them as an advisor, spending time with them, giving them the pitch, hearing their questions, there are ways for you to understand. And as you go through the fundraising process, this becomes more evident and easier to grasp. But it's essentially similar to interviewing. You're interviewing the investor is interviewing you. You want to make sure your personalities match. You have enough time to spend with them and kind of grasp what is the outcome that they're looking for, why they're investing. Are they after taking the control of the company, or they're after supporting you grow? I would say a lot of those things would become evident when you spend time with the investor and kind of evaluate them throughout the process of raising money. You could definitely make mistakes because how can you read people? But it takes a bunch of, I would say, pitches and dealing with investors till you realize that, okay, this person has these red flags. I think I would go nuts if I want to work with them for 8 years. So that would be, I think, one key area that you can use to be able to better understand what the angel investors' agenda is. But I would say trying to get a reference from them and talk to other startups that they have worked with them. That would be the best. The best situation and the easiest one would be if the angel investor starts as an advisor with you, helps you a bit, and then decides to invest. You get a better sense of where they're coming from. What else? What else are you looking for in an investor? I mean, I can tell you, one of the things that I can tell you is that the dynamic of a startup is so fragile that if there are frictions within the team, between investors and the executive team, between the executive team, the founders, and the customers, if there are frictions there at the beginning of the life cycle of a company, things are very fragile and it would lead to failure. So you have to make sure that you avoid any type of friction. You have to make sure that you are dealing with people that are flexible and you can work with them and you can talk to them and you can spend time with them and are willing to help and advise and support. And if there's anything else, it would be just very, very challenging to scale and grow and build a sustainable business. I really assign these 5 minutes times for you guys to participate, but I keep talking myself to kind of fill the void. But if you have any questions, feel free to ask me. The last topic that I want to talk about, and this goes on for a couple of slides, is about exiting your business. And the reason that I think that is important is that whether you're, I don't know, building a daycare business or it's a software for the real estate industry, whatever the product is, you have to think about the exit. Like there comes a day that you're like, I'm tired, or I'm burnt out, or I think I want to do something else, or maybe I want to retire and not work. And it's very important to know what happens after that. Like, would you want to keep the business within your family and have somebody in your family run it? Would you want to give up the business to somebody else and sell it to somebody else and get some value from it? Would you be what would you do after you exit? Like, would you retire and not work? Would you work for the person who acquired your company? Would you start another startup company? These are very important questions that I think most people don't ask themselves when they start the business. They don't think about what happens when I'm tired, or what happens if I want to exit. Okay, we have a comment from Vishal. As you will just read it because you're maybe past that slide. Is that better to get an investor who's willing to take minimal risk, as well as having some previous experience in investing business? Yeah, for sure. Definitely, you want to make sure that you work with an investor was invested in startups before, and I would say that can add value. If you just have cash and you're investing the cash and you're not adding value, that's not really valuable. Like helping a founder in different situations and like having experience to be able to help is definitely key. But yeah, going back to exiting the business, I think these are the questions you should ask yourself. They're really fundamental in also how you run the business, and sometimes also how you think of even bootstrapping or fundraising. What are the triggers of an exit? What happens when an exit happens? And these would be different for different types of businesses, but usually it's a combination of these things. Is that maybe a competitor reaches out to you, or a strategic reaches out to you and expresses interest to do a roll up and kind of take you in. Sometimes there are private equity firms, or there are like bigger players who start to like buy smaller companies in a specific vertical. There are a bunch of examples of those companies where like let's say they go in and buy 5 to 10 companies and then they go even public. You kind of hit the profit level, and so you think that the market is limited and it's not growing. So you look for potentially somebody to buy the business. And then there are different ways for you to think about also the life transition and burnout. Like if you're tired of running the business, if you're moving from one location to another, these could be the triggers for you to think about selling the business. And how does it happen? There's a strategic acquisition where like a bigger corporation buys you and kind of brings you in. Usually the CEO of the startup becomes the lead of that specific division, has to stay around with that larger organization for some time before being able to leave. That is one way. Private equity acquisition happens a lot, where private equity buys businesses that have positive cash flow. They try to then improve efficiencies within the business, or they try to combine a couple of businesses in one sector together to like kind of use their synergies to reduce costs and as a result improve profitability. Sometimes private equity acquisition also requires the CEO to stick around and support kind of the private equity in the operations. Sometimes private equity comes in, buys everything, and doesn't really want anybody to stick around. There's a process called acqui-hire where like a bigger corporation or another corporation comes in and buys you because they want to have the talent within your team. So you might be running out of cash, or your business might be dying, or the product that you have might be not really valuable, but but then a bigger corporation comes in and hires your team because they believe that your team can help them building their product. And then rarely what happens is that there's an initial public offering, you go public and you become a public company. But I would say exits usually are in the form of an acquisition or a merger with another entity. What can you do to initiate an exit? And or what can you do to have a smooth exit? These are the things, again, these are things that people don't think about when they build the business. They don't think about the end. But there are things that you can actually do to kind of trigger an exit or make an exit go forward smoother, or like make it more probable for somebody to come in and buy you. Definitely having a clean structure within your business helps a lot. If your business is all over the place, if you don't have the right documentation, if you don't have the right share ownership structure, etc., it makes it very difficult for somebody to come in and exit and buy you. If you don't have a clear intellectual property kind of strategy, you think everything is kept as trade secret, it's very difficult for people to acquire you. People would acquire you for the tech, the talent, the IP, the customer base, the data. These are the things that would trigger an exit. And if you don't have those things, or if you don't safeguard those things, it would become very challenging for somebody to come in and acquire you. You can put together an exit memo yourself that talks about the rationale, the type of businesses that you think would be a fit to buy you, the value add that you would have to other businesses when they acquire you, and then have a list of candidates, like who are these companies that you think would benefit from buying you. It is very important to have a relationship with the companies that you think could acquire you. You can definitely get a copy of this presentation. Somebody asked a question, can we get a presentation? And the answer is yes. You can definitely build a relationship with the companies that you think would acquire, and that is actually advised. It's very important because, and I would give you another example. If, let's say, you have a solution in the construction space and there's this big company called Autodesk, and Autodesk might have a division that works in the space that you're doing R&D in or building a solution. If Autodesk doesn't know anything about you, the probability of them reaching out to buy you is 0. But if you know their researchers, if you know their investment team, if you know the operation team, if you go on panels with them, if you go to their talks, their conferences, then that relationship is built and you come in their radar, and the probability of them seeing you and wanting to acquire your company goes higher. You can sometimes work with a broker or a banker. This could be expensive and depends on the stage of the company, but like sometimes a banker could go out, run a search, look for potential acquirers, and even reach out to those potential acquirers and kind of offer them something to buy you. Not the best way, in my opinion, and it's usually costly, but it's definitely a way to do things. And then lastly, I would say make the business operable without you. And there are a lot of examples where there is one person that is key. And this is especially true for service businesses. When, I don't know, let's say you are the founder of the business, you have 6 people on the tech team, you have 2 people on the sales side. For some reason, everything ends up with you making a decision and with you running the whole team. Like you have to approve, let's say, what the sales team is doing. You have to approve what the tech team is doing. Without you, the tech team is dysfunctional. Without you, the sales team is dysfunctional. That means that this is not a business. This is just you operating and running things, and this is not something that a new organization can come in and acquire, because it requires you a lot and you're involved in every step of the process. That means it's very difficult to productize it. That means it's very difficult to scale it. That means what if a bus hits you one day? This business is essentially not usable and non-functional. And that's why it's important to think of ways to remove yourself from the operation and make sure you build a product that doesn't require your presence 24/7. Somebody asked me about valuation of a startup at the beginning. I guess when you talk about exit, valuation also becomes very important, because somebody comes forward, they're like, we like you, we want to acquire you. The first thing that comes to your mind is how much, like how much are you willing to pay for this company? And really the idea is that what is the strategic value to that business? Like, is there IP? Are there synergies? Is there a customer list? What is going to be added to my top line and bottom line if I acquire your business? And then can I, if I pay, I don't know, for this business X dollar amount, can I recoup that after 4 or 5 years based on that top line or bottom line? That's essentially the question that defines what is the valuation of your business. The easier way to think about it is that if you have revenue, think about revenue multiple, especially works for software, much easier. If you're a service business, think about EBITDA. Usually EBITDA multiple for a service business could be 1 or 2x, to be honest, not a lot, again, because it really needs you to be able to move forward. What is kind of the structure? Sometimes people offer half cash, half shares. Is it all cash? Is it all equity? Sometimes a company can acquire you and just give you shares and not give you $1. So again, think of that as well. What is the timing like? Are investors like pressuring you to exit? Are you burning a lot of cash or running out of money? Are you getting to the end line? What is happening, and how much time do you have to actually drag this along? And then what are your life goals? Like, would you sell your company for 50 million, or would you sell it for 4 million? What makes you happy? Or you're like, no, if I have a 50 million offer, I'm not going to sell it because this is going to be $1 billion company. Very possible. So it depends on a lot of different metrics. Obviously, the most important one would be what is the value that you would bring to the buyer, but then it is between you, your board, your investors, if you have investors on board, to decide whether this is a fair or a good offer and whether you can negotiate a better offer or not. I guess our last exercise is, what signs do you think you need to think of that tells you that it's time to exit, and how much will you sell your company for? Like, have you thought of that? Like, if I offer you 500K, would you sell it, or would you want $100 million for your company? And what are the signs for you to exit your business? Usually in-person meetings, companies have to write down the stuff on a board, and then they're asked to present them, so we can call them out. It's much easier. Here, I can't easily call you out. So, but yeah, think about it.
John posted in the chat that changing market dynamics.
Changing market dynamic could be a good sign to sell. I mean, sometimes changing market dynamics means that it would be more difficult for you to continue or generate revenue, and as a result, your company would die in a couple of years if you don't sell. Or it could be a positive thing, like could have a positive angle, is that everybody's looking to, I don't know, everybody's looking to build data centers. You have a technology that can quickly build data centers these days. That is very valuable. Big players want to acquire you. That is a great, great reason. Oh yeah, yeah. The example that Jomi shared is that technology changes that could affect your platform which may make it costlier to maintain than new systems. Yeah, essentially there's a change that would lead to your business not being viable in the next couple of years. That's a good time to think about selling the business. SB says when he wants to retire or changing market dynamics, those would be the two timelines. And then also definitely think about how much will you sell your business for. I know it's like a practice of dreaming, but like you can be a dreamer. You can dream, if somebody offers me 50 million, I would sell, or if somebody offers me $1 billion, I would sell. But definitely think about that. Like, how much would you want to sell your business when your business is on a roll, when your business is growing? And that target changes in your head as you build the business, as you get more feedback, as you collect more data points. But after 2 years, you might be like, I think I can get this to 100 million. Yes, Sergey says there's opportunity to start another one, more interesting projects. That is 100% true. A lot of times when we work with entrepreneurs, I have this bad tendency of playing with my tracker, sorry. A lot of times when we work with entrepreneurs, they think that this is it. This is the one business that they could build. This is the idea. This is the product. They have to, like, you've had examples where a company had an offer for $30 million. The founder was like, if I sell for 30 million, I would get like $6 million out of this deal. And that's not enough. And that is a huge mistake, because like probably they haven't received $6 million in their bank account to see how big of a number it is. But also, it's not the only thing that you would build in your lifetime. You can build something, sell it, build something else. You're not married to an idea or a company forever. Like you can always build something new. You can always create something new. If you're an entrepreneur and you have an exit, the second time it's going to be much easier to get money, much easier to build a team, build a product. So I would say definitely think about that. The fact that you can exit and consider another opportunity, and see if you can actually build something new. Deepak says changing market dynamics and government policies are the times for them to think of exits. Yeah, government policies could also be important. One very major dynamic that we have right now is around clean tech companies. I guess before this U.S. administration, decarbonization was very important. U.S. had commitments to decarbonize and lower their emission, but then post, I guess, election, we realized that the new administration isn't really in favor of that. And as a result, clean tech companies are squeezed a lot because a lot of times their business is not really needed because companies now are not looking to decarbonize anymore. And so this is a huge policy shift for a lot of companies. So a lot of companies are either thinking of pivoting their solution from being a purely clean tech or kind of decarbonization solution to something else. Or if they're buyers, if they're acquirers, they're definitely thinking of an acquisition that could happen and an exit that could happen down. That's definitely one reason to think of selling your business. Cool. I guess I want to make sure that there is enough time. I mean, you guys weren't really active in asking questions, but like, thank you as much as you were. These are my slides, but I want to make sure that you leave enough time for any type of questions that you guys have, anything that you want to ask about managing your operation, financing, fundraising, bootstrapping, the risks, what we see in the market, etc. I don't know if it's better for me to stop sharing or I can just keep this slide up. Feel free to connect with me on LinkedIn as well. happy to connect and answer any questions you have as you're in your journey of building a business. Okay, I have 2 comments or questions. One is that it would be when I feel the reach of a startup. Okay, one person says that if they feel that their startup reaches its potential, it's time to sell. This is very similar to revenue or profit is not growing anymore. So an acquisition could be a great way to exit and also make sure your IP finds a home to grow. A question from before, in terms of protecting your IP, does this need to be written into the contract at the time of recruitment that all the development? Yes. Okay. Yeah. So the question is about whether the IP assignment should be in the employment contract or not. There is a clause, a specific. I'm not a lawyer, by the way. You have to like get your lawyer to help you put together an employment agreement. But the answer, as much as I know, as kind of somebody who's seen employment agreements, is that there is a clause in the employment agreement in which employees assign the IP that is generated as a result of their work to the corporation. I would say even the C-level, when we invest, everyone they have to have employment agreements, and everyone they have to assign their right to IP to the corporation, even if you're the CEO of the business, even if you own 80% of the business, because we want to make sure one person doesn't own the IP, the business owns the IP. And so as a result, IP assignment is very important. It should be part of employment agreement. And again, everybody within a corporation should have IP assignment. And they assign the right of IP that they generate to the corporation. Any other questions? Anything you're curious about? I can stop share as well.
While everybody is thinking, Moin, I'm just going to say I am going to share a poll with everybody who is attending. It's just a poll for us at the Innovation Cluster to kind of find out what you guys would like to see in the upcoming workshop. So as you're thinking about the questions, you just have to basically vote in the poll. So I've launched it now. Everybody should be able to see it. So yeah, just select the topic that you would like to see or you'd be interested to see in the future workshops. Maybe we should, Moin, in the next workshop, start with a warning. We will be be warned, we'll be calling everybody out for questions. That's what my first master's looked like during COVID. The professors ultimately started just calling us. All right, guys. If there are no more questions, Moin, do you have any comments to add in? Just last comments before you wrap up?
No, I would say, I mean, there are definitely a lot of topics to cover, especially when it comes to I guess how to bootstrap, how to run the business more efficiently. There are different stories of different types of businesses that have found ways to prioritize revenue. I think definitely look out for those examples. There's this podcast called Founded. I really like it. They just go in and talk about different businesses. I usually try to watch that. It just talks about the history or story of a business, how it came to be, how they found ways to generate revenue, generate product, get to product market fit and grow. Definitely look out for those stories. I think there are a lot of lessons in what other businesses are doing to prioritize revenue. But yeah, I would say that is the key message: making sure that you prioritize revenue, find a way to generate revenue with what you have today. And yeah, and also feel free to reach out, ask any questions. Definitely in touch with the Innovation Cluster team, and I will share this presentation with them.
Amazing. Thank you so much, Moin. Thank you, everybody. I see a lot of people are just chiming in and saying thank you. Thank you so much for giving us your afternoon, for attending this workshop. Thank you, Moin, for such an amazing presentation, for your insight, stories, and practical advice. I know that I see a lot of familiar faces, and we also see some new faces. For those of you who are not familiar with us, at the Innovation Cluster, we're a nonprofit organization that basically supports entrepreneurs working in innovation. And we offer advisory services, tailored programs, access to experts such as Moin, and workshops like this one. So if there's any question or if you want to reach out, please visit our website, innovationcluster.ca. Feel free to book a session with us for more information. And we do have an upcoming, I do see a lot of interest in the polls about mastering product market fit. So we do have another workshop. It's basically a mastering series coming up, which is mastering product market fit. So when you visit our website, do look into that if that is something that interests you. But thank you, Moin. Thank you, everybody, for joining in and for engaging. Yeah, I hope all of you have a wonderful, wonderful rest of the day. Amazing. People are still chiming in. Thank you, everybody.
Thank you.
Thank you.
Yes.
Have a good day. Thanks.
Thank
as
you.
well,
Have a
everybody.
good
Have a
Thanks,
day.
great
Moin.
day.
Thanks, Manal.
Thanks,
Thank you.
Moin. Thanks, Manali.
My pleasure.